My name is Jake, welcome to the channel, and today's video I want to talk about the best monthly dividend ETFs for long-term investors. Now this video is going to be fairly similar to the last couple of videos that I made. Last week I talked about the best value ETFs for long-term investors, and a couple of weeks before that, the best growth ETFs. This video is going to be similar. Like with anything, if you go on YouTube or Google and you type in the best of anything, best ETF, best stock, best whatever, you're going to get different results, okay? And I'm going to try to make this video as objective as I can so that it's not just my opinion and that it really addresses a broad audience, but really that my focus here is going to be on quality. There's a lot of videos out there that talk about monthly dividend stocks and ETFs. I spent a lot of time researching for this video so that I could show you in a very clear and concise way how I view this topic, how I view monthly dividend ETFs, and I want to share that with you in this video today. So the methodology that I use for screening these ETFs, and so that you can understand why I included one ETF versus another, the very first thing that I took a look at was I don't want to have any bonds or treasuries. If you go and you search monthly ETFs, dividend ETFs, you're going to get a lot of bonds and treasuries, and we're not going to include any of those in this video. Second, we're not going to include any cover call ETFs. No JEPI, no JEPQ, no QLD, no cover call ETFs. I want to focus on a qualified dividend. So this means that it's more tax efficient. There's not going to be really a lot of real estate in there, so it's going to be very tax efficient. The next thing is I want to have, ETFs in here that have at least $1 billion in assets under management. And then the next thing here, I want to focus on low expense ratios. And then lastly, no shenanigans. There's a lot of, ways that you can twist and turn, a list like this. This is a very straightforward list. I'm only focusing on equities, stocks, companies, publicly traded companies here in the United States, no international, nothing, just very, very straightforward. So the ETFs that we're going to talk about in today's video, the first is going to be DGRW, the second is DTD, the third DHS, the fourth SPLV, and the fifth DIA. In terms of full disclosure, I do own DGRW in my wife's portfolio. We do invest into this ETF for her. I've talked about this ETF on the channel in the past. The other four I currently do not invest in today, but I could definitely in the future see myself one day investing into them because they check off all the boxes for me. So I'm not talking about any ETFs here that I wouldn't personally own or consider owning in the future. And it's very important. I personally would be hesitant to make one of these ETFs part of my core portfolio. So for those of you that follow the channel, I follow the core and the satellite approach to investing. These ETFs here would generally make up a satellite position. So maybe 5 to 10, maybe a maximum of 20% of your total portfolio, but really nothing more. And that's just my personal opinion. For me, the simple path to wealth with dividend investing is focusing on a core portfolio made up of SCHD and DGRO. I think most dividend investors would benefit from a simple approach like that. However, if you did want to add additional, individual stocks or ETFs like these, for example, these could be great satellite positions to round out, to balance your overall portfolio. Now, my channel is really tailored towards new and beginner investors. I try to help those of you out there that are really new to all of this, trying to understand, is dividend investing the right investing approach for you? My wife and I, we personally are trying to reach financial independence and retire early through dividend investing, and we all had to start from somewhere. And just like you watching this video, I had to learn and do my own research to educate myself and improve my financial literacy. That's what it's all about. We're here all to learn and to grow as investors. And if you feel like you're making a lot of mistakes and you're new to this, just remember that there's always somebody out there that's making more mistakes than you, and it probably looks a little like this.
So us teachers would never ask you students to do anything we wouldn't do ourselves.
Holy crap! What is happening?
Oh my gosh, I love it. I love it. All right, cool. Let's take a look at the very first one. I've talked about this one on the channel before. I've actually made an entire deep dive on this ETF. So what are you getting here with DGRW? So DGRW, it has a little bit of a higher expense ratio than other ETFs that I talk about on the channel. Now, it's important to understand with these monthly dividend ETFs, you're going to pay a higher expense ratio. It's just kind of something that you have to come around to accepting, that this is not necessarily a passive index in the sense of like, a total US stock market. There are going to be more fees associated with it. And within reason, if the fees are reasonable, I'm okay paying them. Otherwise, I really don't like seeing a high expense ratio. And that's why for me, it's a filter on how I'm, analyzing, these monthly ETFs. Okay. So that's the very first thing. Then the next thing here is the assets under management. It has a healthy amount of assets under management. And the very most important thing here is going to be the index that it tracks. Now, I know I'm going to sound like a broken record, but this is so important. An ETF is nothing more than an index, whether it's an actively managed or passively managed, right? And so whatever the methodology or whatever the index that it tracks, that's what you're going to get in terms of the performance, okay? There's no hocus pocus magic, right? Whatever the index is, that's what you get. So when you think about it, don't just say, hey, I invest in a DGRW, but rather think, hey, I invest into the Wisdom Tree US Quality Dividend Growth Index. Now that sounds a little bit weird. You're not going to type that out into a YouTube comment. Hey, I invest in the Wisdom, right? You're going to say, no, I invest in a DGRW and you're, whatever. Or yeah, so understand that the ticker symbol is just the ticker. What you're actually investing in is this right here. Okay. And so you have to understand, well, what is this Wisdom Tree US Quality Dividend Growth Index? Essentially with this index, it's looking at companies that have a market cap of at least 2 billion. And this index that is comprised by Wisdom Tree, this is made from them, like this is theirs. It has 300 companies. Now there's going to be a lot of bogleheads, out there that are true bogleheads. And they're going to say, well, this is a fake index. Well, yeah, I mean, in theory it is, but it's made by the company Wisdom Tree. And what they do is they set certain parameters that dictate the pieces in the index. Okay. So it's not a true market cap index, like plain and simple, like vanilla, like the S&P 500 or the total US stock market. There's other qualitative factors in this index that was created by Wisdom Tree. Now, I know that was a mouthful. Even for me, that was a mouthful. Hopefully you can follow along and understand what I'm saying with this. So really what they're doing is they take a proprietary approach to how they screen this index, and it's unique to them. Okay. Not any other, issuer or company out there has the same index. It's proprietary to Wisdom Tree. Okay. And they're focusing on growth. But the unique thing is they're not looking at historical growth, but rather potential future growth of dividend growth of companies, right? Other indices out there, other dividend growth indices, they look at past performance. This index looks at future performance. Okay. Now I could talk an entire hour on this index, on this company and the approach. That's why I made that video. You can check it out at the end of the video. Next, let's go back here to Seeking Alpha and let's take a look at the top holdings and let's see what you're getting with this index here. Okay, so first off, you're getting a high concentration, very high concentration to technology, consumer defensive and industrials. The largest companies in here, Microsoft, Apple, Johnson & Johnson, Broadcom, and the list kind of goes on and on. And the top 10 weighting is 36%. The number of holdings, there's just under 300 at 298. Okay, so really an interesting index. And as I mentioned at the end of the video, I'm going to stack rank each of these ETFs side by side so that you can see them next to each other. The next on the list here is DTD. This is the Wisdom Tree US Total Dividend Fund ETF. Now, I really like this ETF. Now, from Wisdom Tree, they have a small cap, a mid cap, a large cap. This one right here encompasses everything, large, small, and mid cap. Okay. And so I actually really like this ETF. But here, what you're getting with this ETF is going to have the same expense ratio of a 0.28%. It has a low assets under management. So just 1 billion. So it just barely passes the threshold of 1 billion. And this ETF here is looking at the Wisdom Tree US Dividend Index. So the WisdomTree US Dividend Index, it measures the performance of US companies listed on a US stock exchange, so no international, that pay regular cash dividends and meet other liquidity and capitalization requirements established by WisdomTree. So once again, this is unique to WisdomTree, okay? This index was created by them. And so the difference with this one is that it's dividend weighted, right? So a little bit different than market cap weighted. It's focused on the dividend, so it's weighted by the dividend. Now let's take a look at the holdings for this ETF. You can see here that technology is the highest, but it has a lot less than 30% like the last one. So technology, financials, healthcare are the largest sectors in this ETF. It has just around 23% in the top holdings. You're going to see very similar holdings like Microsoft, Apple. You will have some oil companies in here like Chevron and Exxon. And it has, this is what I really like, it has 821 companies in this index. So very, very well diversified. I'm actually really interested in this ETF. Now let's take a look at the next one, DHS from WisdomTree. This is the US High Dividend Fund ETF. Now, before I go into the specifics of this one, I want to make sure that it's very clear. I forgot to mention this earlier, that the ETFs here, that they're not necessarily ideal for every single person. Okay, if you followed my channel, you've heard me say a million times that the way that you invest is based off of your time horizon. Based off of your time horizon, that's how you should be building a portfolio or balancing out your portfolio so that it meets your goals. This ETF here is better for somebody that is closer to retirement or that is someone who is currently in retirement. So I'll give you an example. If you're 20 years old and you're dollar cost averaging, you're working your day job, and you know that you're going to be working for the next 20 years, you don't want to ideally invest into this ETF. Okay. Now, on the flip side, if you're 1 or 2 or a couple years out before you're planning on retiring, or you just retired yesterday and you're looking to deploy some money and invest into the stock market, this is definitely an ETF that you would likely want to consider or have on your radar. Okay. So very, very important. Don't just blindly go look at a list like this and say, all right, I'm going to pick this one and pick this. Like, understand how you should be investing based off of your time horizon. And if that went over your head, it's okay. What I would recommend you do is go on my channel and watch the videos that I've made on how to invest based off of your time horizon. All right, now with this one has a little bit of a higher expense ratio of 0.38%. It has $1 billion in assets under management. Now, similar to the other two that we just took a look at, this follows the WisdomTree US High Dividend Index. And if you're curious of how this is set up, I'd highly encourage you to go check it out. Take some time, research it, and see if this is the right index for you. Now, the next thing that we're going to take a look at is we're going to look at the holdings. Now, you can see a fundamental difference between this one, right? This is what I'm talking about, everybody. Like, if you have a light bulb moment, this is the light bulb. If you don't understand how to invest based off of your time horizon, someone who's in their 20s, you don't want to have so much exposure to energy. Why? However, somebody who's retiring, they definitely would want to consider, more energy specific, indexes or indices that cover energy stocks, right? So energy is the highest weighted in this index, financials and utilities, okay? And technology just at 7%, okay? So know your time horizon. Top 10 holdings, oil companies, Chevron, Exxon, Philip Morris, Pfizer, AT&T, and IBM. Like, this is the opposite of what you should be doing if you're in your 20s. Okay, so make sure that you know that. Total of the top 10, just under 39%. And what I do like, 391 holdings. So there's good exposure, good representation of the overall market in this ETF. Next, let's take a look at SPLV from Invesco. This is the S&P 500 low volatility ETF. And with this one, the index that is tracking is in the name, the S&P 500 low volatility index. Now, something that I really want to highlight here, this is for those individuals that have a low risk tolerance, that are closer to retirement, that don't want to see a lot of fluctuation to the upside or downside in your portfolio. Okay, so these are low beta, low volatility companies in this index. And really quick before I forget, the expense ratio, 0.25% for this ETF, and assets under management, just over 9 billion. So pretty good. Let's take a look at the holdings, consumer defensive and utilities, right? Low beta, Low volatility, yeah, consumer defensive and utilities, right? And technology, 3%, right? So if you're in your 20s, let me ask you a question. Do you think you should be investing in this if you're in your 20s and you have a 20-year time horizon? Yeah, I didn't think so. Okay, so, but if you're in your 50s or your 40s, or if you're in your mid 30s looking to retire tomorrow and you want low volatility, this could maybe be a good fit, right? So understanding what situation you're in is so important to determine if this is the right ETF for you or not for you, okay? Top 10 holdings, Johnson & Johnson, McDonald's, Coca-Cola, like really great companies. Waste Management, oh, there you go, nice. Very low percentages to each of these. 12% in the top 10 and only 102 holdings. I actually generally, for me, who plans to live off of his dividend portfolio in the near future, I actually really like this. Now imagine for a second, you don't want to build a portfolio yourself and you want to have a fairly diversified portfolio of low volatility, high quality dividend stocks. Well, here you go, right here. Right? Instead of manually doing it yourself and having to track every single one of these individually, you could just invest into this and have the index do it for you. But once again, understand your time horizon, right? So for a lot of people, this could be very appealing. Okay. So once again, as a satellite position, not as a core holding in your portfolio. All right, the last one here is DIA from Spider. This is the Dow Jones Industrial Average ETF. It has a low expense ratio of 0.16%. It has the highest assets under management of just under 28 billion. This index is probably the most straightforward. It's the Dow Jones Industrial Average, and that's it, right? So you're only going to get the Dow 30 in this index. You're going to get the largest in financials, healthcare, technology, etc. And the top weighted holdings, the top is United Healthcare, Microsoft, Goldman Sachs, Home Depot, McDonald's, like really the largest companies in America, the largest companies. And one thing that you'll notice that's pretty interesting as well is there's also, right, like there's a lot of growth and technology companies in this index. For example, if I'm not mistaken, don't quote me, but I'm almost positive like 2 years ago, I believe that ExxonMobil, a legacy oil company, was replaced by a software company in Salesforce, right? So the Dow Jones is not just industrials anymore. You have a lot of technology, you have it's an interesting index, but one thing that you want to make sure that you're aware of, in the top 10 holdings, over 55% are in the top 10 holdings. So a pretty straightforward index. So now if we compare all of these side by side, also against the S&P 500, what you want to take a look at is we're going to look at two things. And I always do this, it's important. The first thing that we're going to look at is we're going to look at the price return. This is what you're going to see on Google Finance, Yahoo Finance. It's just the price. It's not with the dividend reinvested. Okay, so the S&P 500 here, when you don't consider the dividend reinvested, the S&P 500 is performing the best with DGRW, so they're neck and neck, like almost exactly the same. And the lowest one here is going to be DHS. Now, once again, remember this was the high dividend one, right? So really high dividend. This will maybe change a little bit when we factor in the total return. Now, the total return is that with the dividend reinvested. Now, with the dividend reinvested, it does change some things. The S&P 500 is down here. The highest performer is DGRW. There's a reason why why my wife is invested in this one. It's definitely, in terms of total returns, it's been a great performer. And the next one here is going to be DIA. This actually really surprised me. The DIA, the Dow Jones, over the last 10 years has actually outperformed the S&P 500. Did you know that? Be honest, did you know it? I didn't. I didn't know that the Dow Jones has outperformed the S&P 500 over the last 10 years. Now, it's important that you kind of understand that when you look at the timeline, like that dictates, because like since the pandemic here, it's thrown things off so much. Like look at this. Look pre-pandemic, how similar everything was, and then look post-pandemic, how it's just like the gap between the performance in each of these has been so dramatically different. It's such an interesting thing to take a look at pre and post-pandemic. And the lowest performing here is going to be, in fact, the DHS, the high dividend one here. So pretty interesting stuff. And I don't generally look at this and say, okay, I'm going to just pick the very best one. You really want to make sure that you're looking at the index itself, you're looking at your time horizon, but it is definitely interesting to see how they stack rank and compare in terms of a total performance. Now, before we go and we stack rank each of these here, I want to make sure that you understand what fund overlap is. I talked about this in my last video. The fund overlap is essentially how much overlap you're getting in each of these ETFs, right? How much exposure you're getting to the exact same companies if you were to invest into multiple ETFs, okay? So I always use VTI as the benchmark. VTI is the total US stock market. When you invest in this one single ETF, you're getting exposure to every single publicly traded company in America that is market cap weighted, okay? So when you compare, the exposure of the total US stock market with DGRW, you're getting 44% fund overlap. That's a pretty decent amount. That's pretty good. That's a lot of exposure. Okay. Now, if you were to compare that, for example, with SEHD, you're only getting 10% fund overlap, right? So just investing into SEHD is ludicrous, in my opinion. That's why I love investing into DGRO as well as the simple path to wealth. Right? Okay, but we're not going to get into that in this video. So when looking at the fund overlap with DTD and VTI, you can see that there's a lot of fund overlap with 57%. If you look at DIA, for example, there's going to be very low fund overlap. Okay, so this is really important. This is a great tool. I would highly encourage you to play around with this, check it out with your own portfolio, see how it makes sense. In my opinion, okay, this is a blanket statement for the masses here, everybody watching the video. There's always going to be an outlier and it's not going to apply to everyone, but for the very, very majority of people, having a higher fund overlap with VTI is better. Now, let me explain why. In my opinion, you and we can't predict the future. The market is going to do what the market is going to do. The more exposure you have to the market, the less that you have to the less you have to predict the future. You don't have, your crystal ball may or may not be working when you start investing. And so if you don't have a crystal ball, in my opinion, it's probably better to invest where there's more market exposure. Okay. So when I talk about the side-by-side comparison, when I say that I prefer higher fund overlap with VTI, in my opinion, that is very much a positive. All right, now let's stack rank these side by side and let's go from left to right, and I'm going to go through every single one of these, and at the end I'm going to kind of highlight some of the ones that stick out. So the first one is DGRW from Wisdom Tree. This tracks the US Quality Dividend Growth Index. It has an expense ratio of 0.28%. That means for every $100,000 that you have invested, it's going to be costing $280 that will be naturally taken out of the net asset value. It's not like a check that you pay every year. It just gets reduced out of the share price. Okay, so don't let that confuse you. The inception in 2013, assets under management, $8.5 billion. It has 298 holdings. Of the top 10 weighting, it's 36%. The fund overlap with VTI is 44. Over the last year's performance, it's done right around 4%. The 10-year performance, 12%. So really, really good. The best of the bunch here. Since 2013, the total performance with the dividend reinvested is 216%. If you would have invested into this ETF 10 years ago, let's say you invested $1,000 10 years ago, that initial $1,000 would be yielding 5.4%. I like looking at the yield on cost because you can kind of reasonably forecast what it's going to do over the next 10 years, but historical performance is never a guarantee of future performance. The 4-year average dividend yield, this is not the current dividend yield, the 4-year average is 2.1%. So just a little bit better than the S&P 500, okay? And if you go and you look at this one, this ETF does not generally fluctuate. It stays usually, unless there's a market crash, this ETF generally yields right around 2%. If you can get this ETF at a starting forward dividend yield of 2.5%, you're doing okay. The dividend growth of this ETF is the highest at 12%. Absolutely incredible. And because this index focuses on future growth and not historical growth, I am really, really interested and really excited about this ETF because generally as markets mature, their growth rates go down. But if you have an index that is constantly screening for future growth, that future growth can be sustained. So kind of an eye-opener and an interesting index. The next one here is DTD from WisdomTree. This tracks the total US dividend index from WisdomTree, all market caps, small, large, and mid. Has a 0.28% expense ratio, $280 in expenses for every 100K. It was the inception date of, I'm speaking so fast, I'm like, I'll probably have to edit that out. Maybe not. Its inception date is 2006, 1 billion in assets under management, number of holdings 821, top 10 weightings of 23%, overlap with VTI is 57%, the highest there. I like that. The last year's performance is -4%. 10-year performance, this is annualized, right? Annualized. With the dividend reinvested, it's 9.7%. The total return since 2013 is 152%. Yield on cost of 5.4%. The 4-year average yield is 2.6%, and the dividend growth is just under 8%. So these two here, DGRW and DTD, they're fairly similar. Okay, and I could see a case where you could have both of them as a satellite position. They're similar, but also different. Okay, but pretty interesting actually. The third one here is DHS from WisdomTree. This is the U.S. high dividend index from them. It has a little bit of a higher expense ratio of 0.38%. So about $380 per year. Inception of 2006, 1 billion in assets under management, 391 holdings, 39 in the top 10 weighting. It has only 11% overlap with VTI. So if you're going to have this ETF and it only has 11%, you're going to want to couple it with another broad-based ETF like a DGRW, a VTI, or something else that has a higher exposure to the overall market. Even though, this is the interesting thing, even though it has such a large amount of holdings, the percentage is still just very low compared to the overall stock market. It is down 11.5% for the last year. This is not surprising given that dividend stocks have been they've been underperforming this year compared to growth, right? So this 1 year, I wouldn't read too much into that, okay? The 10-year performance is 7.7%, total performance of 110, and the 10-year yield on cost is 6.8%. So like I mentioned, it has a higher dividend yield, and if you have a shorter time horizon, this is definitely an interesting one to consider. 4-year average yield of 3.7%, and a dividend growth rate, which is surprising, 9.4% given its high dividend yield. The next one, SPLV from Invesco. This is the S&P 500 Low Volatility Index, has an expense ratio of 0.25%, so $250 a year. Inception of 2011, 9 billion in assets under management, 102 holdings, 12% total top 10 weighting. I actually like that. That's my favorite. Overlap with favorite in terms of the top 10 weighting. Overlap with VTI only 19%. Down just under 5% for the last year. And then over the last 10 years, 9.3%. And since 2013, the total performance of 143%. Yield on cost of 4.7%. The average dividend yield is just 2%. So this one is also fairly similar. This one doesn't usually have a starting yield above 2%. So anytime you're getting this over a 2% dividend yield, that's a good thing, okay? It has a fairly low dividend growth rate given how low the dividend yield is, okay? So that's something to kind of be aware of. Has a low dividend growth rate relative to its 4-year average dividend yield. The last one here is DIA from Spider. This is the Dow Jones Industrial Average. Has a 0.16% expense ratio. That means $160 per 100K. Inception of 1998. Assets under management just under 28 billion. Holdings 31. Top 10 weighting of 56%. So very, very highly concentrated. Overlap with VTI is very low with just 23%. 1-year performance of 1.8%. 10-year performance annualized at 10.5%. Total performance with the dividend reinvested since 2013 of 172%. The 10-year yield on cost of 4.3%. The 4-year average dividend yield is 1.9%, and the dividend growth rate of over the last 5 years of 5.5%. This is pretty low, right? The 1.9 and the 5.5. This is not my favorite Now, a big part of this is because there's also really, some non-dividend payers in this index. Okay, so that's part of it. But it has, for me, it's a pretty low dividend yield. So you're really buying quality with this one. This is more of a very, very sleep well at night. When looking at what sticks out, so for me, what sticks out the most, now what I'm looking at is obviously you want to take a look at the fund methodology. This, as I mentioned earlier, this dictates what the performance will actually be based off of the index. Then what I like looking at are the number of holdings. What takes the winner here for me is DTD. And then the top 10 weighting, I really like SPLV. The overlap with VTI, I really like DTD. And when it comes to the past performance in terms of a total return, DGRW takes the cake with that one. If you're looking for yield today and you want high yield, then then DHS is probably the one for you. And in terms of this is an interesting one. So I don't have this highlighted because this is subjective. This is really depending, this is all relative based off of what's important to you, based off of your time horizon, okay? That's why a lot of people on YouTube, where they just throw out blanket statements and say, this is the best ETF, because they're doing you a disservice because they don't know your time horizon, okay? So depending on when you plan on living off of the dividend and the dividend income, that could be different for every single person, okay? If you're in your 20s and you have a long-term time horizon, these are obviously really, really great. If you're maybe a little bit nearer to retirement, these may be a little bit better for you, right? And then the dividend growth rate, this is pretty objective. It's DGRW. So for me, these are the 5 best monthly dividend ETFs out there. And really, it starts with the expense ratio. Anything higher than the expense ratio here, for me, it's just, I wouldn't touch it unless it's a covered call ETF. But that's a whole nother topic. These are more straightforward ETFs. I wouldn't go higher than this expense ratio. But yeah, I hope that you'll learn something new, and I'll catch everybody in next week's video.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.